Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Melbourne Wargent Property Buyers, and as usual, I'm here with Chris Bates from the Flint Group. Chris, how's things?
Things are good, Pete. It's I can feel the Christmas. I actually came out on the weekend when I had the kids for the day, and the Christmas tunes are going. And it's sort of head down, bum up now for the next 6 weeks. My wife's birthday last week. We did a bit of Halloween. Next week it's my boy's turning 3, so we've almost got through the trenches. I would say it's you're long gone through that, Pete. You're in open plains, but how's it feel on the other side?
It's pretty good. We've actually had 3 birthdays in the past week or two here as well. So lots of celebrations and cake. It's pretty interesting, actually. We went down to watch a movie at the weekend at Sunshine Plaza, and all the Christmas baubles are up, Christmas decorations, and you kind of almost do a double take first week of November. But I suppose from a retailer's perspective, it starts to ramp up pretty much from now. So yeah, it's almost a question of where's the year gone, because before we know it, people are talking about the Christmas break and the silly season, and it's pretty hectic up here anyway, because it was the Noosa Triathlon this weekend, and all the roads were closed down, traffic everywhere. But yeah, I mean, it's before we know it, it's 2 or 3 more weeks, and people will be starting to turn their minds towards the big wind down. And we're actually recording this on Melbourne Cup Day anyway, so half the country's not really working that hard today.
Yeah, absolutely. And a bigger thing's going on if overseas, right? The US election. It's going to be interesting to see how that one plays out. But it's always an interesting time in the markets this time of year. Around Melbourne Cup's kind of like the end, right? A lot of it say once Melbourne Cup's happened, no new listings come on, and when you're driving around, you see no more boards go up, and you see these sold stickers sort of come on. And I always like to just sort of track them up to Christmas and see if they finally get that sticker. Or a lot of them actually go off the market at this point, Peter. If you see the same thing and they sort of give up and go, well, I'm not going to get a best sale price now, I'm going to relist it in sort of Feb or March next year. Do you often see that at this time of year?
I think so. Actually, we went to a few auctions over this weekend just gone, and even at this stage in the cycle, seeing some really big results in Brisbane. I think just a function of low supply. There was a big sale in Wilston. It was 1.6, just a standard 405 square metre block, and then 1.5 Wavell Heights. I think there was a Brisbane record over the weekend in Ascot, $23 million sale. So there's a fair bit of cash floating around. I think in Sydney and Melbourne, there's just a little bit more stock and more listings coming onto the market, which has dampened the environment, but it's not the same everywhere around the country. And as you've talked about many times, if you look at the total number of listings Australia-wide, it's just not that high for this time of year. So it'd be interesting to see as we go through December, January, whether as buyers start to spark up for the new year. Well, there's not that much supply really when you look around the traps.
Yeah, I mean, I'm always probably tragic, like I said before, but I was looking at the Melbourne market on the weekend and just going through option results and looking, I've been tracking that market for, at least a decade now. And I guess I was still surprised the market down there has just done nothing, right, for almost sort of 7 to 10 years. It's crazy. You could buy something but not that much cheaper than it is today, back in 2016. And so I think it's very, very good buying down there. And these are absolutely aspirational family homes on good suburbs, close to the city, on decent blocks. And yeah, they've gone up a little bit, but they haven't done anything like that prices have been around the country in, places like Brisbane and Sydney. And so, I think if you're living in Melbourne, or you want to move to Melbourne, or you just want to get an investment, I think it's hard to look past Melbourne right now. It would be my bet, if you think the same.
I think so. When you're looking at markets, but the tendency is often for people to look to the hottest markets for the prospect of immediate gains. But if you look around the country, Perth prices are up 23% from a year ago. Adelaide's up 15%. Melbourne is down 2%. And I guess if you're looking for value, you would say, well, that's where it is. And there's a few different challenges in Victoria at the moment. And I guess every week there seems to be a new tax announced, and there's a lot of issues, a bit of unrest, and loads of things like that going on in real time. But if you're a market cycles person, you'd probably say of all the capital cities, Melbourne is now offering the most value comparatively. And I think some of the smaller capitals did have that in about 6 or 7 years, but now swung back towards potentially Melbourne. So, yeah, I tend to agree. I think it's interest rates on hold for the time being. Actually, on the day of recording, it's an interest rate decision day. Monetary policy typically revolves around the Melbourne Cup race, but consensus is kind of moving towards maybe a February interest rate cut, and that if met with low supply, that will potentially just spark things up a little bit in Melbourne. And as you said, a lot more value there than you might see in some other places.
But yeah, I mean, obviously the US election, there's lots going to happen over the next three months with sentiment. It could go either two ways, get a bit more bearish or a bit more bullish. And, by the time listings come on in January, you could find that confidence is much higher or lower. So, let's kick on with the 3 stories this week, Pete. Obviously, every Sunday we try to cover 3 stories of the week. And what have we got cracking this week?
Well, let's start with the interest rate story. I guess this always is in the media in Australia, but I think it was interesting to see this week. Fin Review did a piece. No more interest rate hikes are now being called, or even by the Hawks. I think the poster boy for the rate hawks this cycle has been Warren Hogan from Judo Bank. And I think he was previously chief economist at ANZ. I know you've interviewed Warren many times. I know he's a big golf fan like myself. And I think he has been probably the most hawkish of the commentators. Previously, he was calling for 3 interest rate hikes. I think he's now sort of thinking, well, no further hikes, but he potentially sees that maybe a first cut could be pushed out for up to 12 months because the jobs market is still holding up really well. And even a lot of other market economists have pushed out their expectations continually, really, for interest rate cuts. But do you think that does anything to the mindset of buyers? Because I guess previously we were seeing quite a few headlines about the need for further hikes and more tightening, maybe 3 more hikes and so on. But I guess there's nobody really now calling for that. And I guess the argument is really turned towards when do we see a cut? And if so, how far do interest rates need to fall?
Look, when Warren talks, I love to listen, to be honest, because he's a super smart chap, extremely down to earth, given what he's done in his life so far. He's just and he's so smart, and he knows how to cut through the noise. And I have interviewed him a few times on the Elephant, and I just love chatting to him. He's just got so much knowledge in his head. And you're right, he's been the one who's probably been against the markets, which is brave for economists. Most economists just join the pack and don't put their head out. But Warren absolutely has said, rates need to go up. I'm talking rates over 4% at the RBA when everyone else was thinking 3s. And so he's pretty much called it. So what he's saying here is that, rate cuts aren't as coming as fast as people think. And it's going to be happening, late sort of 2025 rather than, as strong as they were thinking maybe a few months ago. I think that urgency has probably gone a little bit, which I've said in the weeks before. It really picked up when the rate expectations really tanked, US job numbers and, rate expectations where rate cuts may even been this year. I think there was a little bit of, let's get ahead of this, let's buy before these rate cuts. And particularly on the higher end, we saw some bigger transactions, but I would say that's died off in October a little bit. Definitely still more transactions at the lower end, which has definitely been the story for the last few years. But that top end isn't as sort of, keen to enter. But I think, that once the confidence comes around rate cuts, they'll be absolutely back in the market. But yeah, I think that was an interesting story with Warren. He's, he is sort of still saying rate cut, no more rate hikes, but he's also saying rate cuts aren't going to be a sure thing till potentially November next year, which, that's a long time away. That's a full year next year. And that means the market won't perform that strongly because there's an affordability sort of limit that's sort of holding the market up now. Once rate cuts come, people's appetite to take on debt increases, people really stretch, people, get more intergenerational wealth, people's borrowing capacities come up, maybe APPA steps in. That's when, the market will take that next leap up. But until then, I do think there's a bit of a handbrake on prices, hence why prices haven't been sort of rising in Sydney as much.
Well, yes, there's definitely an interesting thing when it comes to predictions markets. And we've been seeing this, of course, with the US election, and we've seen it previously with the Aussie election, that it's quite difficult when everybody else is predicting one thing to be the one person who sticks their neck out and says something different. Of course, if you get it right, you can make a name for yourself. But there does tend to be a sort of a herding aspect to this. And I suppose if you're a chief economist at one of the big major banks, you don't want to be the one economist who says something different, and then it all sort of turns out that you were the person who got it wrong. But if you take a look at the Bloomberg survey, so if you look at all of the economists around the country that are surveyed by Bloomberg, if you look at 4Q 2025, so that's basically the end of next calendar year, the lowest interest rate forecast is Market Economics, which I think is the kook, 3.1%, and the highest is 3.85%. There's a couple of banks there. So I suppose if you look at most of the predictions, they're looking at 3.35 or 3.6. So maybe 3 or 4 interest rate cuts over the next 12 months is the consensus, if you like. But as we've seen many times, it's often the person who makes the outlying predictions that takes the biscuit, if you like. Steve Keen famously was always an outlier forecaster, and maybe every third year he would be the most accurate because he's the person who sort of sticks his neck out there. I know if you read Nassim Taleb and the Black Swan, they would say, well, it's all well and good making these predictions about what might happen over the next 14, 18 months, but who really knows? I mean, we could have any number of potential things might come along which change things. But at the moment anyway, nobody's predicting more interest rate hikes. Most banks are looking at February for a cut, and then probably somewhere between 3 and 4 over the next calendar year. So, but yes, you're right. It's definitely put a handbrake on prices in Sydney and Melbourne to some degree. I think borrowing capacities have been hit. A lot of younger, lower income earners have been locked out. A lot of focus on average mortgage sizes, which have sort of rebounded to record highs. But I think at least a part of that is a function of lower income earners simply being unable to borrow, being stress tested at 9.5%, and therefore the average is kind of skewing higher. But it's largely people with deeper pockets, a bit more wealth, and higher incomes who are actually active in the market.
Yeah, I'm not sure if we covered it last week, but the APPA discussion basically on APPA and the buffer, and the banks were sort of split in two, which was actually a bit surprising. I thought all the banks would, before APPA, were cutting the serviceability buffer, reducing it from say 3 to 2%. And that increases borrowing capacity, which means the banks can lend more money, but they sort of split in the middle. I think 2 are on one side, 2 are on the other, and I think that's going to be a bit of pressure next year because it depends on how you want to look at it. If you're saying that, and all the data proves this, that medium and higher incomes, you usually also have access to greater likelihood of intergenerational wealth. Well, they can transact in the market because A, they've got more money for deposit and through families, and they're earning higher incomes. Well, they can still be active, but the other ones are completely destroyed. They haven't got the deposit, and they also can't borrow that much based on their income, and prices haven't gone down anywhere near as much as borrowing capacities. And so I think there's going to be an argument, but unfortunately the banks are being a bit naive when they say that because they know, though, once you give people more borrowing capacity, that'll quickly get factored into prices. It doesn't take a rocket scientist to figure out that when you give people more money and they're already going to their limit, they're going to have to spend it because their competitor's going to have to spend it. And then all of a sudden prices jump by borrowing capacities. And that's happened time and time again over the year. That correlation between borrowing capacity and prices was actually really tight. I think Carlos Cacho, who was at Jarden, who's now moved to Macquarie, and I loved his research on this. And, when borrowing capacities fell, there was an expectation prices would fall just because that correlation was so close over the years. Over the last couple of years, when borrowing capacities fell, they thought prices would fall, but they didn't. So, but I do think when borrowing capacity goes back up, prices will very quickly match that.
Well, it would make sense that the two banks with the biggest market share would be against any changes because I suppose any change to lending policy would impact their potential to sort of carve up the market. It was interesting, actually. Westpac put out its latest results this week, and just running through the numbers, I guess stressed mortgages as a percentage of total credit exposures, just rising. Nothing dramatic, but things have just been ticking a little bit higher. But I think results were just a little bit softer for Westpac. I think when you actually look through the slides in the investor pack, you can see there's just not that much. what they would call riskier lending around. Interest-only mortgages are now just 11.8% of loans by value in total. So it's not so long ago that half of the entire mortgage book was on interest only. Now it's under 12%. So most mortgages are paying down. Australia's household debt to income ratio is actually trending lower, and a lot lower if you factor in offset balances. And a lot of those fixed rate mortgages, which were considered to be a risk, well, the peak of the expiry was way back in September 2023, and that's been tapering off ever since. So, yeah, I mean, it's kind of, I guess the environment that we're in is there's pretty tight lending standards overall, probably as tight as we've seen in a lot of respects. But it's not really helping the new housing supply, and it's a bit of a detriment, I suppose, to the lower income earner who can't get into the market to buy a new apartment, to buy a first home. So, yeah, it's things is kind of the pressure is kind of building up, if you like.
Yeah, and I think the higher borrowing capacity doesn't always focus just on people in the market. So, home buyers looking to buy or upgrade, or investors looking to transact. A lot of the higher borrowing capacity actually will help people with current mortgages. And I actually think this is a good thing, right? Because homeowners have been paying fair whack off their mortgage over the last few years. And, potentially depending on where they own, they're going to build a bit of equity, particularly if prices start to run a little bit. And once they can get access to that equity, that can basically build them a buffer. That could help them do renovations. It could help them just build a buffer so they could help force not to sell the house, and do other things like pay off, say, credit card debt and things that, they've had to do. So I think this higher borrowing capacity, together with wage increases over the last few years, is going to allow people to feel much more comfortable with their mortgages. So I think you'll see a refinance boom when borrowing capacity goes back up, because people will want to sort of top up their coffers a little bit and build those buffers. So let's go to story number 2, Pete. What do you say?
I think you're absolutely right, because I actually do know of some people who've been borrowing at pretty high mortgage rates because that's all they've been able to do, maybe with a non-bank. But the general thinking is maybe in 12 or 24 months' time, I'll refinance the whole portfolio, possibly back to a lower mortgage rate and on more favourable terms. But it might be some way off depending on changes to the interest rate, changes to lending policy. So, yeah, you're right. Second story, Aussie housing is a pressure cooker. So there's a couple of articles. The AFR did a piece saying developers are pushing for more construction worker immigrants. Construction workers should be 10% of migration, big developers urge. And also in macro business, Leith Van Onselen went through the reasons why the housing supply is building up to be this pressure cooker environment. Obviously, interest rates higher for longer has been a big factor in killing supply. A lot of construction firms are not making profits and they're going insolvent. There's been some pretty high-profile scalps over the past year. A general sort of shortage of skilled workers. I think the infrastructure projects around the country have sort of crowded out some of the available labour supply for the housing market. But I think the big point is that affordable apartment projects just aren't stacking up. I think premium developments, we're seeing a lot of those getting built and approved, but there's just no end in sight, it seems, for the apartment supply shortage. Sydney last month saw the approval across the whole of Greater Sydney, 660 attached dwelling approvals. Well, that's the lowest month in 12 years, except for one very seasonally quiet January. You'd have to go back a dozen years to find a weaker month than that. Plus, a lot of those projects are being approved and not commenced. So, yeah, I think if you look around the country, yes, Perth is getting some housing supply underway now. Melbourne is doing better than most. But if you look at the areas where there's a massive shortage building up, it's kind of suburban Sydney, eastern suburbs Sydney, affordable apartments just aren't getting built. And, in Sydney, it's very difficult to approve large volumes of detached housing because there isn't the space. So, there's a lot of analysis there, but it just seems like the general environment is just a building up pressure cooker.
Yeah, and I think building apartments, I was just reading some articles this week as well, and, the cost to build per square metre on apartments versus the cost to build, say, a house and land package is chalk and cheese. It might be sort of double or triple the price per square metre by the time you look at the cost of the development taxes, and, the construction costs are much higher when you start going high in the sky and versus on a nice flat piece of soil, on the fringes, right? And a cookie cutter sort of modular type of home. And also did a recent partnership with Equity Mates and Matt Barry, the CEO of Freelancer, who's, very property bear and has been calling a property bear for years, right? And he's written some pretty emotional articles over the years. And he sort of really touches on, the migration issue in Australia and, and how we've been letting in a lot of people into our country. And I think it's always two sides to these stories. But I do think, how we grow our population and who we let into the country and who we don't, and, making it sure it matches what we need as a country is a big conversation. I don't think, and we've got a lot of like universities that rely on sort of this, and that supports our economy, etc. So, I think this population sort of story is going to get worse and worse, because if you fast forward 5 years, I'd say we're still going to have a rental crisis, because the number of investors investing in our capital cities, particularly on the East Coast, and in areas where we had an oversupply in the past, so it was easy to rent. I feel like that's the rental accommodation is really shifting. A lot of investors are going to the regional locations, and they're going to Perth and Adelaide, and our rental stock's shifting. Maybe it doesn't change over 1 year, but I think over 5 years, you could see a massive change there. I think housing affordability is not going to go anywhere, and so you have a rental crisis plus an affordability crisis, and people are going to look for people to blame. And I think this is what they'll do: is they'll blame, new migrants, which is I don't think right, but I think that's what people will do.
I think so. Yeah, I mean, it's I saw a quote from the Fin Review piece, but Stockland's chief exec Tarun Gupta said in a roundtable, he said that private sector wages growth is running above 4%, but many of the workers needed to build new homes, concreters, electricians, plasterers, and so on. They're basically going for the higher pay, things like mining projects, energy transition, infrastructure projects. And Gupta said that in a lot of projects, costs have risen by around 60% for apartments. That's double the uplift in revenue, and it's really squeezed their margins. And I think on the population piece, Canada is probably the sort of ground zero for that kind of debate, because Canada's population increased by 1.2 million last year, all of it from immigration, not from people living longer or birth rates or anything like that. It's just very, very high immigration rates. The government is going to get voted out, partly due to that, as well as various other challenges. And there's now a big push to take immigration back to zero. I mean, they've gone to from one extreme to the other in Canada, and some other countries have had similar challenges. I think in Australia, most people would agree that the snapback from the pandemic has seen population growth run at a level we just can't build for, not just housing, also for infrastructure. But it will probably level back off, I think, over the next 6 to 12 months, because that base effect is washing through. The students have already come back and so on. But it's going to be a big debate going forward for a lot of developed countries, because birth rates are generally lower, fertility rates have been falling, populations are aging, so there's a lot of competition for those new graduates, particularly from Far East Asia and so on. Look, as somebody who's not only an immigrant myself, but also who travels a lot around the country, I'm generally a pro-immigration person, but I think most developed economies, or many, I should say, are finding out that you can have too much of a good thing. And in particular, what the roundtable was talking about is specifically targeting the skills that Australia needs, and not just going for numbers, trying to target the immigration policies towards the skill shortages.
Do you think, Pete, a lot of this issue is that the state government and federal government boom spending in COVID is that, we'll just basically throw money everywhere, and absolutely threw so much money around infrastructure. You've got roads, metros, train lines, all sorts of things happening. The Olympics are up where you are in Brisbane, and you think that's just, you can't keep spending money, right? So, but these projects take many, many years, until those sort of all run off, and then we go, hang on a sec, what are they actually just state government doing? Oh, they're just fixing, some road signs, and they're not doing too much, even though it's probably not the state government. But you know what I mean? Do you think the infrastructure spending is really causing these issues?
Oh, that's been a big part of it, for sure. I think it's always easy to stand on the outside and throw stones. But I suppose it's easy to forget that if you went back to even the first half of 2020, nobody really knew where things were going. And the Reserve Bank said they wanted to build a bridge to the other side of the lockdowns. The government stepped in with some massive counter-cyclical spending. There was all of the furloughs for wages and JobKeeper and Home Builder and all those stimulus packages, but they do come at a cost. And I think for the construction sector, a lot of builders took a lot of work on fixed price contracts, which ultimately they couldn't fulfill. Infrastructure spending has been enormous. It probably has peaked now, but it takes a long time for a lot of those projects to get completed. So that's definitely been a factor. I mean, of course, we do need infrastructure spending in Australia, but it's a very difficult period when the borders were closed and we had a shortage of materials and a shortage of labour. And of course, yes, you're right. At the state government level, we just had an election in Queensland where we had 50-cent bus fares and there was free school lunches and, pretty much any policy you can think of where the state government was stepping in with free money, it was being thrown around. And I guess in the lead up to a likely election in, say, April or May next year, the federal government may well be tempted to do the same thing. This week, Albanese has been talking about 20% forgiveness on higher education debts. And there's a lot of policies like that which may not be inflationary immediately, but they could be down the track. And certainly if there's more handouts, like we saw in the state election, that's certainly going to add to the demand at a time when supply is pretty tight.
Yeah, should we crack on with story number 3, Pete? Because it's an interesting chat, Tarek Booker, and he writes a lot of provocative articles. What did you think of this one?
Yeah, so he's been doing some good stuff on social media and in writing for news.com. So give him a follow if you don't already. Tarek Booker wrote an article for news.com.au this week. So the hidden reason for the housing crisis as Aussies turn their backs on apartments. So even in the midst of a full-blown housing crisis, there's one type of home that a lot of Aussies haven't been buying, even though they're generally more affordable, and that's new apartments. I think this is true. I think a lot of buyers were kind of burned in the previous cycle. There was a lot of issues with construction defects. There was a lot of high-profile apartment towers and blocks where there were major issues in places like Mascot and Olympic Park in Sydney. I think quite a lot of people bought off the plan and found out 2 or 3 years later on that maybe those units weren't worth what they wanted them to be worth. So it's interesting. Tarek, he puts in a lot of statistics and graphs and charts to back up his viewpoints. And it does seem that when you look around the surveys, most Australians still want to live in freestanding houses or townhouses. And there's been a sort of a bit of a turning away, I think, from new apartments. So when you look at per capita, it does seem that Australia does build a lot of housing, but maybe sometimes the supply that gets built just isn't quite matching with what the demand really wants.
Yeah, absolutely. I mean, I think there's been a huge shift. If I go back to 2014, 15, I was very anti off the plan and, and we're getting spruiked apartments everywhere and particularly in that boom as well. It was a high density boom driven by a lot of investors and a lot of those properties haven't even gone up since 2016, 17, even though there's been, sometimes multiple booms in these cities. Some of the premium prices people were paying for apartments back then, and they haven't aged well as well because they were built pretty cheap and not that tastefully, right? The standards weren't that great because investors weren't that picky. They weren't saying, I want a really good build that's bigger and light and, it really suits family markets. They were just like, I'll just buy an apartment, buy anything. And I think what I've also saw back then is there was never really a concern around the building quality and, defects. And I think all that sort of got found out. And I think a lot of people have been reading the news for the last 10 years and realized that buying new has risks. We don't, it probably is a bit of, because we are anti it and we don't put ourselves out there as, people who help people buy off the plan and buy new. So we don't see too much coming to us. But even still, I would say over the last few years, we've seen even less people come to us who have signed up to some off the plan and we're having to, help them get out of it, which is very hard, to be honest. Or, if they do have to settle on it. And a lot of them have been able to offload them. And a lot of people have actually been able to offload those purchases back, 2015 to 2017, or even if they went and got stitched up and they bought an apartment in Brisbane, those apartments in Brisbane have gone up in the last few years and they've finally been able to to get rid of them, and after them being, well underwater for some time. So, yeah, I think that's the challenge, right? We're going to shift into potentially one of our solutions for housing affordability is building new apartments together with new townhouses and new houses and all sorts of things. But I do think, buyers are going to be very fearful to buy them. And so hence why state governments are doing so much work to try to fix that with building commissioners and, rating builders and all sorts of things. But confidence has been smashed, and it takes a while to come back, Pete.
It does. I think, sometimes we might be making a few enemies with these points, but just for some context, I've been working with clients on property strategy since around 2011, and I was an investor before that. And I can tell you that probably 90% of the time when somebody comes to me and they've got a major portfolio issue, negative equity, properties worth less than they paid for them or underwater, it's nearly always where somebody's bought a new project of some description and the price was extremely expensive when they bought, and then the depreciation kicked in. And then, 5 or 10 years down the track, they're kind of stuck because, do you hold out and just hope for prices to go back up, or do you just cut your losses, which is sometimes difficult to do if the property is worth less than the mortgage? It's just really borne out by experience is that, the amount of times I see people get into real trouble, it's very often to do with new stock for various reasons. I think at the moment, the temptation for people is to buy a new house because they see mortgage rates as 6 or 6.5%, depreciation benefits maybe 15 or 20,000 in the first year, which is very tempting. But you got to remember that those depreciation benefits on paper on your tax return, they do reflect that you're probably buying a much more expensive property to buy brand new, and you're also quite likely being pushed out into a new housing estate or a new tower block. And there's going to be lack of scarcity in the product. There's a lot of competition for that type of dwelling because almost by definition, they're building many more of them. And that's really where the risk comes in. And often valuation shortfalls come about because there's just no comparable sales for valuers to look at. So, Chris, just to wrap up on this story, there was also an article that you read from Productivity New South Wales on housing supply challenges. No surprises here, but they basically found that since 2018, barriers to housing supply have included high construction costs, high borrowing costs, capacity constraints in the construction sector, so the skills shortage, and also bottlenecks in the development process. So they came up with a range of recommendations about how to address this in terms of freeing up capacity to build more homes and streamlining development processes. But I've been reading about streamlining development processes for decades. It never really seems to move the needle. What happens to get housing built is when it's profitable for developers to build, when interest rates are going down and when prices are going up.
Yeah, and I do think they're going to be a bit of an increase in prices, particularly if I think about the Sydney market. You're probably seeing it in Brisbane as well, to be honest, and Melbourne to a lesser extent if we just go around the East Coast. But, a lot of home buyers are absolutely buying apartments. They're not buying the new stuff. They're going and buying the Art Deco, the brick buildings, the ones with sunrooms with, 4 or 8 blocks or 12 blocks, where there's maybe a communal garden. They're in the sort of more affluent parts of cities where houses are very expensive. And they are building more apartments in these suburbs, but they're not targeting that demographic. The new apartments are probably double the cost of current apartments. They're almost not that far off house prices because they're targeting the downsizer, right? The downsizer probably doesn't need to release too much equity from their home. The kids want it because they want the cash from the parents, but the parents are like, well, I know you guys are going to have grandkids and I know you guys are going to want to come around our place because you guys can't afford to enter the market. So we need a bigger apartment. We need a 3-bed, 2-3 baths with a courtyard and double parking. And so those apartments are, and the build costs make them very expensive, and they're really only suiting the downsizer or maybe a home buyer that just doesn't really, a young family or a growing family that, goes, oh, maybe we've put our upgrade off a bit late. We will basically have no backyard, but we know the kids are only going to be with us for another 5 years. And they're just going to have to deal with that. Well, because this is going to suit us when we retire. And I think that's what's getting built in these. So that I think you are seeing price growth on these apartments because there is a limited supply. And bit by bit, families and couples are competing on them as long-term homes. And And so once the prices of those go up, it does mean that developers can basically build more for that part of the market because they can finally do projects for that part of the market, plus the more affluent sort of downsizer as well. You sort of see similar things, Pete, up in Brisbane?
Absolutely, yes. Somebody pointed out I say absolutely too much on this podcast, and I managed to get nearly 95% of the way through, and then I finally said it. Yes, we are seeing that. Established units in some of those blue chip suburbs are doing really well because people are priced out of the middle ring suburban homes, and they want to be in locations where they can walk to work or cycle in or jump on the ferry. Got cafes in every corner. But yeah, it's much more, I think, skewed towards established units in little blocks of 10 or 12 and low strata fees. It's not the big complexes with expensive pools and gymnasiums and 24-hour concierge and all the facilities that people aren't using. And I think we'll see the same thing in Melbourne over the next 5 years. I know we've been saying it for a while, but you can buy in some of those really nice little suburbs like Elwood or places like that, you can buy an established unit or St Kilda maybe, and it's less than the cost of replacing the unit. So I'd say, I guess if you're a value investor in the stock market, you're trying to buy something for less than it's worth. And I think in some of those markets, they haven't done a lot for 10 or 12 years, but I think they will over the next decade simply because the cost of new supply is going up so much. So yes, that's about it for this week. So we're recording this on Tuesday. I guess the US election will be sort of getting underway as we record this. Voting's happening. I guess things will probably be a little bit clearer by the time this goes to air. At the moment, the polling's very close and there's a million opinion pieces. So it'll be nice when it's all finished because it seems to have been dragging on for months.
Yeah, come on, man. I hit you last week. Harris or Trump?
Well, you put me on the spot because this is, by the time this goes to air, it will already be known, but I'll go with a Republican victory this time.
Okay, there we go.
What about you? Come on, you must be.
Let's go. I'd love to say Harris will win, the first female president. I mean, that's pretty special if you're honest. I think that's pretty inspirational, to be honest. And I think in comparing to Trump, I think that's my bet. But anyway, we don't want to make this about politics. But
we saw in the UK as well for another female leader for the Conservative Party elected this week, Kemi Badenoch. So maybe it is time for that. So we've got the newly revamped Rask website happening now. So if you get on there, you can track down, if you want property coaching, you can find the link to get in contact with me on there. And also, as always, if you want to chat to Chris or the guys at the Flint group, there should be a link there you can follow through. So have a cracking weekend, Chris, and everybody listening, and look forward to seeing you next time around.
Absolutely. Happy Sunday, everyone.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.